Over the past 9 weeks on The Algorithm Investor, we have covered a lot of ground. We have talked about what the stock market is and why it matters, how to open your first brokerage account, why index funds beat most professional investors 90% of the time, how ETFs work and which ones to consider, the psychology that costs the average investor 4% per year, dividends and how to get paid for owning stocks, how to read an earnings report, what recessions are and how to survive them, and the power of compound interest applied across every area of your financial life. Today in week 10, all of that comes together into one place. We are building your first complete investment portfolio from scratch, a practical step-by-step framework you can implement this week regardless of your age, income, or experience level. This is not theory. This is the actual portfolio construction process. By the end of this video, you will have a complete blueprint specific to your situation. Let us start with the foundation. Before you build any investment portfolio, there are 3 financial prerequisites that must be in place first. Skipping these and investing anyway is one of the most common and costly mistakes new investors make. Prerequisite 1, a fully funded emergency fund. 3 to 6 months of essential living expenses held in a high-yield savings account. Not invested. Not in a brokerage account. Liquid and accessible. This is what prevents you from being forced to sell investments at the worst possible time when life happens. Prerequisite 2, high-interest debt eliminated. Any debt charging more than 7 to 8% interest should be paid off before you invest a single dollar in the market. Credit card debt at 20% interest is a guaranteed negative 20% annual return on your net worth. No investment consistently beats that. Clear it first. Prerequisite 3, a basic understanding of what you are investing in. You now have that from the previous 9 weeks. You understand markets, index funds, ETFs, dividends, psychology, and compound interest. You are ready. With the foundation in place, let us build the portfolio. We are going to walk through 4 different portfolio frameworks, one for each stage of the investing journey. Find the one that matches where you are right now. Framework 1, the absolute beginner portfolio. You have just opened your first brokerage account. You have between $50 and $1,000 to invest. You want maximum simplicity with no ongoing maintenance required. The One Fund Solution. VT. Vanguard Total World Stock ETF. One purchase. 9,000 companies across the entire global stock market, US and international combined. Expense ratio 0.07% per year. Set up automatic monthly contributions of whatever amount you can afford. Enable dividend reinvestment. Check it once per quarter. That is the entire portfolio. This is not a beginner version of a real portfolio. This is a genuinely optimal portfolio that many sophisticated investors use for their entire investing lives. The simplicity is the point. Framework 2, the 3-fund portfolio. You have been investing for 6 to 12 months. You have between $1,000 and $25,000 invested. You want slightly more control over your allocation while maintaining simplicity. 60% VTI, Vanguard Total US Stock Market ETF. This is your growth engine. The entire US stock market in one fund. 30% VXUS, Vanguard Total International Stock ETF. Geographic diversification beyond the United States. 10% BND, Vanguard Total Bond Market ETF. Your stabilizer. Reduces volatility and holds value when stocks decline. Rebalance once per year, every January. If any allocation has drifted more than 5 percentage points from target, sell some of the overweight position and buy the underweight one. This forces you to sell high and buy low automatically. Framework 3, the core and satellite portfolio. You have been investing consistently for 1 to 3 years. You have between $25,000 and $100,000. You have strong convictions about specific sectors or companies and want to express them without abandoning the proven foundation. 80% core, split between VTI and VXUS in a 70-30 ratio, for U.S. and international exposure. 10% Satellite 1, a sector or factor ETF you have high conviction in. Technology via XLK, healthcare via XLV, dividend quality via SCHD, or value factor via VTV. 10% Satellite 2, individual stocks of companies you have researched thoroughly using the earnings report framework from week 7. No more than 3 to 5 individual positions. Each position sized at no more than 3% of your total portfolio to limit single stock risk. The core protects you. The satellite gives you the ability to act on conviction. The sizing discipline protects you from yourself. Framework 4, the tax-optimized portfolio. You have been investing for 3 or more years. You have accounts across multiple account types: Roth IRA, traditional 401k, and taxable brokerage. You want to maximize after-tax returns through intelligent asset location. In your Roth IRA, your highest growth assets, small-cap stocks, REITs, dividend ETFs like SCHD. These generate the most income and growth, and all of it compounds tax-free forever. In your traditional 401k or IRA, your bond allocation and any assets generating regular income. The tax deferral makes bonds more efficient here than in a taxable account. In your taxable brokerage, your broad market index funds, VTI and VXUS. These are tax efficient by nature, low turnover, minimal capital gains distributions, and you control when you realize gains. This asset location strategy can add the equivalent of 0.5 to 1% per year in after-tax returns without changing a single investment. Over 30 years on a growing portfolio, that is a significant amount of additional wealth from a purely structural decision. Now, let us talk about the 5 portfolio decisions every investor must make regardless of which framework they choose. Decision 1. Your equity to bond ratio. A common starting point is 100 minus your age as your stock percentage. At 30 years old, 70% stocks, 30% bonds. At 50, 50% each. This is a rough heuristic, not a rule, but it gives you a starting point anchored in your time horizon. Decision 2. Your U.S. to international ratio. The U.S. market represents approximately 60% of global market capitalization. A market cap weighted approach says hold 60% U.S. and 40% international. Many investors tilt more heavily toward U.S. given its historical outperformance. Anywhere from 60-40 to 80-20 U.S. to international is reasonable. Decision 3. Your rebalancing frequency. Annual rebalancing is supported by evidence and minimizes transaction costs and tax events. More frequent rebalancing adds complexity without meaningfully improving outcomes for most investors. Decision 4. Your contribution amount and schedule. Whatever you can automate consistently beats whatever is theoretically optimal, but requires willpower to maintain. Start with an amount that feels slightly uncomfortable, enough to feel meaningful, but not so much that you will stop if circumstances change. Decision 5. Your investment policy statement. Write down your portfolio framework, your target allocations, and crucially, exactly what you will do when the market drops 20, 30, or 40%. Your calm, rational self writing this document today is protecting your future emotional self from making decisions you will regret. Let us bring this all together with a concrete example. A 32-year-old professional, annual income of $65,000, $5,000 in savings, no high-interest debt, no existing investments. Step 1. Build the emergency fund first. 3 months of essential expenses, approximately $7,500. Already have $5,000. Need $2,500 more before starting to invest. Timeline: 4 to 6 months of saving. Step 2. Open a Roth IRA at Fidelity. Contribute the maximum, $7,500 per year, by automating $625 per month. Step 3. Initial investment inside the Roth IRA. 100% VT for maximum simplicity. As the account grows past $10,000, transition to the 3-fund framework. Step 4. If employer offers a 401k with matching contributions, Contribute at least enough to capture the full employer match before maxing the Roth IRA. Free money from an employer match is always the highest priority investment available. Step 5. Write the investment policy statement. Target allocation. Rebalancing rules. What to do in a crash. Review it once per year and only adjust it when your life circumstances genuinely change, not when markets are making you nervous. That is the complete framework. Simple, evidence-based, tax-efficient, built to survive market cycles, resist emotional interference, and compound reliably over decades. You now have everything you need. 9 weeks of foundational knowledge and a 10th week portfolio blueprint. The only remaining variable is whether you act on it. The gap between knowing what to do and doing it is where most financial outcomes are determined. Not by intelligence or income or access to special opportunities, by consistency of action over time. Next week on The Algorithm Investor, we are starting our second series. We go deeper. Stock valuation methods, how to analyze a company, advanced ETF strategies, tax loss harvesting, and building towards financial independence. Subscribe so you are there from the start. For everything you need to build real wealth, subscribe to The Algorithm Investor. New video every single week. Drop a comment below. Which portfolio framework matches where you are right now? Beginner, 3-fund, core and satellite, or tax optimized? I read every single one. See you next week.